Good afternoon.
Good afternoon.
Welcome to the webinar
Welcome
hosted
to the
by the
webinar hosted
IRC
by the
Institute.
IRC.
Sounds like we have a little
Sounds like we
backbeat
have a
here.
little
Let me
backbeat here. Let
check
me
my audio real
check my
quick.
audio real quick.
And I think we have the audio fixed. Welcome to the webinar hosted today by the IRC Institute, Passive Investors, Not Passive Owners. Our agenda today is introduction, review of the research, IRC Institute's perspective, and then questions. For the logistics, all attendees are in listen-only mode, but your questions are encouraged. At the end of the presentation, we'll take your questions. Just type them into the question box on your control panel. You'll receive a follow-up email with a link to a replay of this session, which is being recorded. This report and all others are available on the IRC Institute's website, www.irrcinstitute.org. If you'd like to share information about this report, you can use our Twitter handle at IRC Research. If you have any issues during the webinar, please call GoToWebinar at the number there on your screen. Our speakers today are Ian Appel, PhD. He's a report co-author and he's an assistant professor of finance at Boston College. Ian has much experience in terms of corporate finance and institutional investors, and his research areas are corporate finance, law and finance, and institutional investors. He has his PhD from Wharton, an MS from Johns Hopkins, and his BS from Duke. Our second speaker today is John Lekumnik. He's the executive director of the IRC Institute. He's been in that position since the organization was founded in 2008. He has a wealth of experience in corporate governance and investor issues. He previously served in many roles, including the investment advisor to the New York City pension funds. Just a few words about the IRC Institute. It's a nonprofit established initially in 2008 and established in 2005 and launched in 2008. Essentially what the organization does is it funds and disseminates unbiased research that's helpful to investors and policymakers on a broad range of investor issues. We have an annual research award with two $10,000 awards. This report here is one of those research award winners. There are more than 40 research reports available at no charge on the website, and we have a new website that rolled out late last year that's got a much more robust platform for finding and searching research. Here's a list of the research just to give you a sense of the broad range of issues, environmental issues, corporate governance, a whole host of issues. And now I'll turn it over to Ian, and he will provide an overview of the research. Ian?
All right, can you hear me?
Yes.
All right, wonderful. So this is joint work with Todd Gormley and Don Keim, both of whom are at Wharton. And as Kelly said, the title of our paper is Passive Investors, Not Passive Owners. We actually borrowed this title from a report Vanguard put out, which they argue that even though many of the funds that they offer are passive in nature, they actually take quite an active role in having discussions with management and influencing different aspects of corporate behavior. And in fact, the results of our paper have echoed this thought. And so specifically in this paper, we're defining passive institutional investors as funds that deliver the returns of a specific market index. So it could be the S&P 500 or the Russell indices, for example. And as the figure on this slide shows, these passive investors are a large and growing component of total institutional ownership. So here we're plotting the percentage of equity mutual fund assets that are passively managed. And we see a dramatic increase from below 10% in 1998 all the way up to over 30% by 2014. And in fact, in recent years, for every dollar that's been invested with a traditional actively managed mutual fund, we now see $6 that are invested with one of these passive investors. And so they are really becoming a dominant force in the markets. Next slide, please. Now, it's not necessarily clear if the rise of passive investors that we've seen in recent years is necessarily a good thing. And so, for instance, there was an article in The Economist last February that wrote that a rising chunk of the stock market sits in the hands of lazy investors. Index funds and exchange-traded funds mimic the market's movements and typically take little interest in how firms are run. Now, it's worth noting as well that many of these managers of passive funds have aggressively pushed back against this notion, and they've written a series of op-eds in newspapers and magazines arguing that, no, this impression is not correct. In fact, we care quite a bit about things like corporate governance. Next slide, please. And so, in this paper, we're asking if passive investors influence aspects of corporate governance. And there's certainly reasons to think that the answer to this question is no, and that passive investors, in fact, weaken corporate governance. So the first reason for this is that passive investors may simply lack influence since they're unwilling to accumulate their positions or exit positions if they're unhappy with managers. Furthermore, it could be that these passive investors lack motivation. Their goal is primarily to deliver the benchmark performance, and so they may not actually care about the returns of any one particular stock, since increasing the returns for this stock will just increase both their portfolio returns as well as the returns of the underlying benchmark. Now, on the other hand, there's reasons to think that passive investors could in fact strengthen corporate governance. So one reason for this is that passive investors have a fiduciary duty to their own shareholders to vote in the best interests of the investors. Furthermore, it could be that passive investors are motivated if fund flows not only respond to performance relative to the benchmark, but also absolute performance. And finally is this idea that since passive investors are largely unwilling or unable to exit their positions, they may in fact care more about corporate governance than other types of investors. Next slide. So ultimately, answering this question in a rigorous manner poses an empirical challenge. And the main reason for this is that correlation does not imply causation. That is, if we see that passive ownership is associated with things like improved corporate governance or improved performance, we can't necessarily deduce that this is being caused by passive investors, since passive ownership could vary along with other things. That is, firms with higher passive ownership may have higher active ownership, for example. And so, in order to really tease out a causal effect here, we're going to need to use what us economists refer to as a natural experiment. Next slide. And so the experiment we're using here, the empirical setup we're using, focuses on using variation in passive ownership around the cutoff between the Russell 1000 and the Russell 2000 indexes. And so the Russell 1000 is just the 1,000 stocks according to market capitalization, and the Russell 2000 is the next 2,000 stocks according to market capitalization. Now, every June, Russell determines the index assignment for the following 12 months using the end of May market cap. And so once you're put into a particular index in June, you stay there unless there's a significant corporate event. Now we're going to study this Russell setup between 1998 and 2006, and we end in 2006 because Russell ultimately changed their methodology. They implemented what's known as a banding policy, and it sort of complicates our analysis. Now, an important thing to know about the Russell 1000 and 2000 indexes is that they are weighted according to market capitalization. So the biggest stock in each index by market cap receives the largest weight. And ultimately, this results in portfolio weights varying considerably around the threshold between these two indices. Next slide. And so this is something that's demonstrated in the following figure. So in the first panel of this figure, we're plotting the portfolio weights for the bottom 500 firms in the Russell 1000. And in the second panel, we're plotting the portfolio weights for the top 500 firms in the Russell 2000 index. And like I said before, these are value-weighted or market cap-weighted indices. And so as you would expect, there's a large jump in the portfolio weights at the top of the Russell 2000 relative to the bottom of the 1000. Now, it turns out there's a similar amount of passive assets tracking each of these indices. And so this ultimately results in passive ownership being significantly higher for firms that are at the top of the Russell 2000. Next slide. Now we can see this break in passive ownership in the following figure. So here what we're doing is we're taking the bottom 500 firms in the Russell 1000 and the top 500 firms in the Russell 2000, and then we're ranking these stocks according to their market cap. Now, when we line up these stocks, so stock 0 is the biggest stock in terms of this sample that we've isolated, we find a break in passive ownership, and on average, it's about 66% higher for those stocks that are at the top of the Russell 2000. Next slide. Now, we're going to use this, so formally speaking, we're going to use this in what's known as an instrumental variable estimation. And we're particularly interested in studying governance outcomes here. We specifically focus on governance issues that are explicitly mentioned by passive investors as being important. And specifically what we do is we go through the proxy voting policies of a number of these investors and find what are the common threads here in terms of what they think constitutes effective governance. And ultimately we find that passive ownership is associated with firms having more independent directors. We find that when firms have more passive ownership, there's a higher likelihood of them removing anti-takeover provisions. So this could be things like poison pills or restrictions on shareholders calling special meetings. And we find that passive ownership is associated with fewer dual-class share structures. That is, we see one share, one vote. And like I said, these are three common things that are commonly discussed by passive investors in their proxy voting policies. And in each case, we find results that are statistically significant at least the 10% level, though they're typically stronger than that. Next slide. Now we next turn attention to what are the possible mechanisms here. That is, how are passive investors able to have this influence over aspects of corporate behavior? One possibility is the power of their voice. And so voice is a term that can either refer to informal communications with managers perhaps, or it could also be formal things like proxy voting. And given that these passive investors have such large stakes, it stands to reason that potentially their voice is a powerful tool here. In fact, we find some evidence that this is in fact the case. So for instance, we find that when passive ownership is higher, governance proposals, so non-binding governance proposals, receive higher support, while management proposals receive less support. So in some sense, this suggests that managers are facing a more hostile or more discerning shareholder base. Another possibility is that passive investors facilitate activism by other types of investors. So for instance, activist hedge funds. That is, if a activist hedge fund sees that passive investors own large stakes in firms, they may realize that if they're able to obtain the support of just one or two of these investors, this could ultimately lend credibility to an activist campaign and increase the odds that it eventually succeeds. However, if anything, we find evidence of a decrease in activism by other types of shareholders. Now, this doesn't necessarily mean that activism isn't important here. It could be that managers realize that when there's higher passive ownership, this increases the odds of an activist attack, and they in turn make changes in order to preempt this. However, another possibility is that the changes implemented by passive investors through things like using their voice ultimately negates the need for an activist to come in the first place. Next slide. Now finally, we turn attention to an analysis of performance and other types of corporate policies. Now, the reason why passive investors care about governance is presumably because they think that this is going to improve firm-level performance. However, it's not necessarily clear that we would expect this to be the case. So first off, the value implications of specific governance structures, so things like either independent directors or whether a firm has an active poison pill, for instance, are widely debated in the academic literature. There's papers that say these things are good for firms, bad for firms, or don't matter at all. Furthermore, there could be concerns that passive investors are taking a one-size-fits-all approach to corporate governance. That is, they're applying these same governance policies everywhere, while maybe it could be that governance is perhaps more nuanced than this, and they should be applying different governance ideas at different firms. However, we actually find that on average, passive ownership is associated with higher long-term profitability. So specifically, we're measuring profitability here by using return on assets. However, we can also use measures of value that are commonly used in the academic literature, such as Tobin's Q. And specifically, we find that a 1 standard deviation increase in passive ownership is associated with a third of a standard deviation increase in ROA. Now, it's worth noting here that we conduct a number of robustness tests. And in fact, we can measure passive ownership in a number of different ways. And so throughout the main results in the paper, we use mutual fund level data, but we obtain largely similar results if we also use institutional level 13F data as well. Furthermore, we conduct robustness tests in terms of how we construct our sample, and I refer you to the paper if you're more interested in learning more about these. But again, we find that the results in this paper are robust to many different specification choices. Next slide. All right, and so I'll wrap up here. And so the main takeaway from our paper is that while these passive investors are not active in the traditional sense, that is, they're not going out and launching proxy fights on their own or anything like this, we find that passive investors are in fact not passive owners. And ultimately, these findings point to the idea that institutional influence is not limited to those investors who are active, that is, those that can go and buy shares and sell shares whenever they want, or activist, and so meaning investors who specifically buy shares with the intention of influencing management. And ultimately, we view our findings as highlighting the importance of voice as a mechanism to influence different types of managerial decisions. And that's it. Thank you very much.
Thanks, Ian. It's John Lukham. I want to thank you very much for that presentation. Just a couple of comments to provide some context and to emphasize some of the things the paper shows. My background is as an institutional investor, and I have run pension funds, been a managing director at hedge funds, etc. And I've always been mystified by the view of indexers as lazy, per that Economist article, which, by the way, gave no empirical evidence as to why they thought that. Historically, in fact, large indexers have always been concerned with corporate governance, and it's not just asset managers, it's asset owners as well. So, for instance, many of the founders of the Council of Institutional Investors, which is the largest trade organization for institutional investors in the United States that's concerned with corporate governance, they were passive allocators. New York City's pension funds, CalPERS, etc. And they exactly gave the answer Ian gave, which is, we're locked in. We don't have exit. We have to choose a voice. And our research in terms of how large investors use, for instance, proxy advisory firms and everything else, indicate the same thing. The large indexers are very, very conscious and devote resources to their corporate governance analysis. There are some other reasons for this as well. Next slide, Kelly. As Ian said, indexers may not be concerned with the differential performance of portfolio companies. Another way to say that is they're not concerned with the relative performance of their portfolio versus the benchmark over a short period of time. But that doesn't mean they're not concerned with the absolute performance of their portfolios over time. Number one, this matches the reason that people generally tend to invest in index funds. They are offsetting long-term liabilities, and their absolute performance is actually much more important than their relative performance. But also, there are economic benefits to the firms, to the Vanguards or BlackRocks or State Streets or Mellons or other passive indexers of doing this. There's an economic incentive. All fees, asset management fees, are asset-based if, in fact, you can, as Ian's research shows, improve absolute performance, your assets under management go up, your fees go up. That's not a differential versus your competitors, but it is an absolute fact over time. You want assets to grow. Second, having a robust governance team, or nowadays even a sustainability team, is a way to differentiate your offering. I know for a fact, having been involved in searches for close to $10 billion worth of allocations to index funds, they are largely commodities because they don't have differentiated performance. One of the things that's differentiated is how much attention the engagement staff and others do, and that's one reason why you will see some of these firms speaking publicly about their governance efforts. It's a way to differentiate their firm versus the competition, and that influences where large institutional mandates go. And the third is it does demonstrate thought leadership, and that is important both in terms of the marketplace and something that doesn't get talked about much, but also in terms of your competition for talent and for your own workforce. So this false narrative that's out there that index funds are lazy or delegate or don't care about governance because all they have to do, after all, is match the index and they've done their job, isn't proven out. In fact, is contradicted both by experience of those in the field and now by this paper, which uses, I think, a very elegant sort of discontinuity model at the edge of the Russell 1 and Russell 2, as Ian said, a natural experiment to show that these firms care deeply about governance and, perhaps more importantly, affect the governance of American companies. With that, I'll turn it back over to Kelly.
Terrific. So we'll move on to the Q&A portion of the webinar now. Just as a reminder, if you'd like to ask a question, there's a question pull down on your control panel. Just type your question in there. I'll read it aloud, and John and or Ian can respond to your questions. So let me just exit out of the PowerPoint so I can pull up my question. Okay, the first question, do you think the same results would hold if using the S&P 500 rather than the Russell indexes?
Okay, that's a good question. And so, if you look at the number of dollars benchmarked to the S&P 500 versus the Russell indices, it's very obvious that the S&P 500 is orders of magnitude larger. And so, in some sense, you might think that this would be a better environment to look at some of the issues we're looking at. However, the reason we're not, and the reason why we are specifically looking at the Russell indices, is that, as I mentioned, the Russell indices are constructed simply by picking up the top 3,000 stocks according to market cap, and then cutting off the stocks after the top 1,000. Now, again, as a caveat, this has changed in more recent years, but this is how it was done during our sample. Now, what's nice about this environment is that there's presumably nothing else different between a stock that's ranked number 1,000 and is the last stock put in the Russell 1,000 versus the stock that's ranked 1,001 and is the top stock in the Russell 2000. And so this means that as long as we rigorously control for market capitalization and only look at a relatively narrow window around the cutoff between both of these indices, we can be quite confident that we're looking at firms that are similar or along other dimensions, but have this one difference, which is their level of passive institutional ownership. And this is important because it ultimately lets us to tease out a causal effect. Now, the problem with using the S&P 500 is that the way that these indices are constructed is a bit more complicated. And so S&P takes into account a number of factors, not just the size. And so while we know what the top 500 firms in the S&P 500 are, it's not as clear what firm number 501 is. That is, what's the last firm that didn't make the cutoff to get into the S&P 500. And so it's not obvious then what we need to control for in order to make the causal statement like we're trying to do in this paper. But thank you for your question.
Thank you. Our second question, what is the correlation between passive ownership and specific governance issues particularly pay/performance link and capital allocation?
So that's a good question. So we do look at uh, CEO compensation some in the paper, and we find weak evidence that passive ownership has some effect on this measure. That is, we see that CEOs get more sensible pay arrangements in some sense that are more tied to performance or lower when passive institutional ownership is higher. However, we don't find very strong results for this. Now, one caveat, though, is that our sample predates say on pay. And so it very well could be that, now that institutional investors have access to say on pay, perhaps this is an alternative mechanism that gives them more power to influence aspects of how CEOs are compensated.
And a follow-up question. Also, what have you learned about the role of proxy advisors? Do passive investors who use proxy advisors vote differently? If so, is that cause or effect?
That's another good question. So we don't specifically look at proxy advisors here. However, previous research by Michelle Lowry points out that many of these index funds are active voters, actually, in the sense that they're more likely to go against the recommendations of proxy advisors. And in fact, if you talk with some passive investors, they'll say, off the record, of course, that they have a very low opinion of proxy advisors. And given the fact that the largest passive investors have these large governance teams in place, and presumably these are the guys that are really sort of dominating our results here, that can explain the bulk of it. It stands to reason that perhaps proxy advisors don't play as big of a role as many people would initially suspect with this.
Yeah, let me just add something there. We actually had Tapestry Networks do a report on how large institutional investors actually use proxy advisors. I mean, there are lots of correlations that suggest how much of a vote a proxy advisor can swing, but we were more interested in what actually happens in terms of process. And there are a couple of interesting findings. And again, all this research is up at ircinstitute.org. It includes Ian's paper, this Tapestry paper on proxy advisors. And I would just point out a couple of things. In the United States, which does not have a national corporate governance code, the proxy advisors are a amalgam of order taker as well as order maker. They are trying to reflect their client base, of which these large index funds are an important aspect. And so one of the things that people don't consider when they look at the effect of proxy advisors is what are the proxy advisors' baseline codes of conduct that they are trying to enforce, which they have actually received often from the marketplace, from these index funds and from active funds. And that happens before any particular recommendation on any particular company. Later on, as Ian says, these are the large index funds are some of the best staffed and quite honestly some of the most expert governance staffs in the business. And the way they typically use proxy advisors, yes, they use some analysis, but they use them to flag which of the tens of thousands of issues they have to vote on need to be paid attention to, and then they do their own analysis, either in place of or to supplement the proxy advisor's analysis.
Thank you. Our next question, you mentioned results for takeover defenses like poison pills. Do you look at things like staggered boards as well?
Oh, sorry, I was on mute. So yeah, that's a good question, and this is something obviously in recent years there's been a lot of talk about, and clearly we've seen the number of staggered boards, at least amongst very large firms, going down. And so we do take a look at staggered boards, and we find suggestive evidence that when passive ownership is higher, firms are more likely to get rid of their staggered boards. However, I should note that this result is not statistically significant, but it's worth pointing out that this could also be sort of an artifact of the time period we're looking at. And so specifically, our sample runs between 1998 and 2006. But the real efforts, the real sort of push to de-stagger boards didn't really begin until the last couple of years of our sample. And so this might explain why we're not really finding, we find a negative coefficient, but not really significant results when we look at this particular aspect of corporate governance.
Thank you. Our next question, can you say anything about the effectiveness of passive investors relative to other types of institutional investors like active mutual funds?
Okay, so that's an interesting question. And so in our experimental design, when we use this Russell 1000, Russell 2000 cutoff, we see that passive ownership goes up. But of course, that means that they have to be buying the shares from someone. And so it could be that they're buying shares from more actively managed mutual funds, and so we see that going down. However, it turns out that's not the case. And so we don't find a change in the ownership of actively managed mutual funds or other types of institutional investors. So presumably that means that the shares that are being bought by passive investors are coming from sort of the omitted group here, that is the group we don't have data on, which is largely speaking the retail investors. And so our results can be interpreted in light of passive investors buying shares from retail investors. It would be interesting to compare sort of how effective monitors are passive investors relative to more active investors. And you could come up with stories. There's certainly theoretical reasons why that could go, they could be better, or in fact they could be worse. However, it's not really clear. We can't disentangle that in the experimental design that we're using here.
Thank you. Another question we have, how does the collective choice issue impact initiatives beyond responsiveness to proxy items? Isn't it, quote, rational apathy, a more apt term than laziness?
So, I mean, I think that's one way. I think that's a good way to put it. And so, kind of in the presentation, I was sort of laid out reasons, and I think that explain why people have this prior that either, okay, maybe it could be, and this is one of the reasons I gave, where in fact it is rational to be apathetic, since maybe passive investors have nothing to gain if all they're trying to do is to track the indices. However, and I think John did a great job of pointing this out in his discussion, I think there's certainly incentives for passive investors to care about corporate governance, and there's certainly reasons why they want to have a real impact, and it's not, you know, sort of just a marketing ploy that they're doing, and that they have real reasons to care about this and to take actions that matter. And so while, yes, I think you could call it rational apathy, and probably lazy is a bad word, I agree, I think there's compelling reasons why that's not the case.
Jeff Gordon at Columbia coined the term economically rational for them not to engage in the way that activists engage. And I think that what's interesting about this study is there are different levels of engagement. As Ian said, we're not talking about Icahn or Ackman-like activism. We are talking about widespread cross-the-market standard setting effectively. And it is economically rational not to sink millions of dollars into a single stock, but it may also be at a single company and try to affect that. But it is also economically rational to try to improve the overall return of the marketplace for the reasons cited. I think you have to distinguish between types of activism, and even if you were looking at sort of a cost-benefit analysis, it may in fact not be economically rational for a large index fund to pick company X and say, we want to change the board. But it may very well be economically rational for them to follow what's going on in an activist situation and make an informed vote there, and perhaps more broadly, as this paper suggests, try to set minimal standards across the marketplace that indexer believes will help corporate governance in general.
Great. Well, that looks like that concludes our questions. We thank everyone for their participation. Again, if you have any follow-up questions, both John and Ian are available to answer any of those questions. Their contact information is here on this page that you can see on your computer. Again, this webinar has been recorded. We will send out a link so that you can listen to a replay if you're interested. And we also will post on the IRC website these slides so that you can refer to them at your convenience. So again, we thank you for your participation and we hope that you have a wonderful afternoon. Thanks.